you usually set up yourself when you're looking at big data docket items? What do you look at? Is it volatility, expectations? Where do you start, Chris?
Yeah, it's a great question because, everyone's told that our primary job as traders is to manage risk, and one of the biggest risks that you can have is how we deal with known event risk. And of course, central bank meetings, non-farm payrolls, ISM manufacturing numbers potentially, but these things, we get into such a crescendo of excitement about what this could mean for potential tweaks to policy further down the line that we start positioning around that, and expectations obviously build into that meeting. So it's our job as traders is to understand what those expectations are, looking at various positioning around that and the potential moves around that. So the first thing I would do is actually I go to the options market. I'm not sure if you've got a chart there, but we're looking at overnight Aussie dollar options, and really what I do, as you can see, this kind of messy squiggly line chart here, but the way that I formatted this is looking at the implied volatility in the Aussie dollar overnight. So this is taking overnight options, daily options, and it's one of the big components of the pricing of the options is looking at the expected movement, the implied movement. And you can plug that into the Black-Scholes model, or through the various programs, and it will tell you the pricing, whether an option's expensive or cheap. But ultimately, for me, breaking this down in simplistic terms, we can see that number is around 12%. That's an annualized standard deviation number. So what we're doing is we're looking for context around that. That tells me is the market on a day expecting big moves in the Australian dollar. Now we can see it's coming up to the sort of top end of the range. But for an RBA meeting where so much has been discussed and some major announcements were due, it's not particularly high. So the question I would be asking is, am I concerned about holding positions over this when the market is telling me that they're not expecting major moves? And the answer is that I wouldn't be too concerned. If it was back up to say 15-16%, then I would probably say, yeah, look, I mean, if I've got long Aussie dollar positions or short Aussie dollar positions, I may look to reduce that exposure because the market is expecting some big movement. And what you can actually do is divide that number by 15.9, and you'll get a number which is the expected move in the Aussie over that period. But yeah, I mean, basically, it's not me taking a judgment call. This is the broad market making a judgment call on expected movement. The next one I would look at is broad positioning. And there should be a chart on the Commitment of Traders report, which looks at Aussie dollar futures positioning. Now, for people who are unfamiliar with this report, what I look at within this report, you can sort of go into the nuts and bolts. And one of the reports within the Commitment of Trade reports, which looks at various asset classes, various instruments, and the dealers or the market's participants, whether they're long and short, and we aggregate those positions. I've got here hedge fund or leverage, what they call leverage fund accounts. Now you can look at asset managers, you can look at primary dealers or market makers, and other reportables as well. But I look specifically at hedge fund activity because why? Because they're just like me, a bit more sophisticated, but they are moving positions around very quickly, and the way that they think about FX markets is the same way as I would think about it largely. And you can see there that the market was running a reasonably long Aussie dollar position going into the meeting. So the first two things I'm thinking about is volatility high? It's okay, but not too bad. I'm not too concerned about holding exposures. The second thing is the market long Aussie dollars or the fast moving market, and yeah, you can see they are. The next thing would be, which I don't have a chart, is obviously I'd look at rates pricing. We'd look at 30-day interbank markets or swaps markets just to see what the market's discounting over the coming year or 2 years. And then, despite all the various factors that are playing through, does the statement marry up to what's already being priced in there? We saw about 3 rate hikes being priced over the next 3 years. So, if you look at the statement, does it justify what's being priced in? Yes and no, but largely it does. I think that's why we're not seeing a huge amounts of volatility there. So there's a number of ways we do it, but certainly looking at the options market to see what the market's expecting in movement, that shapes your position sizing. If it's too great, I would reduce my position, or I would take it off the table altogether, because in those cases it can be a coin toss and it's outside of my control, and my job is there to manage that, and I'll get out of the position.